Hello, it's Joshua here with another edition of Mortgage Clarity. And in this episode, we're going to talk about Mortgage 101 as it relates to conforming loans, also known as conventional loans. These are actually interchangeable words. You'll hear lenders talk about them both. What they're really talking about is any loan that's underwritten to meet the minimum underwriting requirements of either Fannie Mae or Freddie Mac. Now, I say minimum because the lenders can always choose to put additional restrictions above and beyond the minimum requirement. But as long as these loans are underwritten to meet these minimum standards by these programs, that makes that loan eligible to be purchased by either Fannie Mae and Freddie Mac. Now, why is that important? Well, the reason this is important is because Fannie Mae and Freddie Mac's purpose in the market was to provide liquidity. So when lenders lend money for mortgages, they typically sell those mortgages, they package them up in what's called mortgage-backed securities, and they get sold in the secondary market. Now, this is very important for lenders because if they did not do this, then once you lent out the money you had on hand, you'd be done lending. But by being able to put these into packages and sell them to the open market, it now becomes a global market where other countries, other companies, and pension funds are able to purchase these assets as a place to park their money while generating a rate of return. So the lender can then sell that into the market. They get their money back plus a little bit of profit, and then they're able to do the loan again and keep things going. Now, Fannie Mae and Freddie Mac's purpose is to make sure that that market, that secondary market, is always liquid, meaning that regardless of what's happening in the economy, there's somebody that's going to be willing to purchase securities if somebody wants to sell them. Without this here, if you had a run in the market like we did in 2006 with the housing correction, nobody would want to buy the mortgage-backed securities, and they would be stuck, and that would be detrimental to companies and the economy at large. So Fannie Mae and Freddie Mac, that's their purpose. They're actually under conservatorship of the U.S. because in 2006, there was the run on the bank. Their charter required them to be buyers when everybody wanted to sell. And so they did need the federal's backing to come in and help them with that. So that's kind of what the little history. Now, what's the difference as far as loan programs and what does that mean to you guys? Okay, well, there's some pretty important ones, but we're going to hit the highlights here. One main difference, I would say, with conventional / conforming loans is that they're more credit sensitive than the government programs. These conventional loans typically work best for people that have higher credit scores, although you do not have to necessarily have a high credit score in order to use the program. Now, a lot of people used to think conventional programs required larger down payments, but this is not true. You can actually get a conventional loan with as little as 3% down, which is lower than the FHA program that requires 3.5%. So now back to the credit requirement, we talked about sensitivity there, is on a conventional loan, the top credit, which gets you the best rate, would be like a 760. Now there's lots of little things that go into adjustments as far as property type. Is it a primary or secondary or investment property? But for this video here, we're just talking about the best rate at 760, and then every 20 points your score goes lower, that could have a negative impact to the cost for the rate that you're looking at. That cost becomes too high, then you go up to take a higher rate to offset that cost. So when you start to get credit scores below 700, it has a pretty good impact, or can have a pretty good impact, depending on your down payment, on the cost of that rate. The other thing that's different with conventional versus the government programs that we've talked about in the other 101 videos is the mortgage insurance. So mortgage insurance is that item that you need that if you're not putting down at least 20% that you're required to have. Now, to know more about mortgage insurance and if that's good or bad, check out other episodes below that talk about mortgage insurance. But in short, the takeaway here is that on a conventional loan, unlike government where the mortgage insurance is set, so regardless of your credit score, you're going to get the same mortgage insurance. With conventional, it's not provided by Fannie Mae or Freddie Mac. So their loan approval might require that you have mortgage insurance, but they're not going to provide it. So you have to go into the secondary market or the open market to purchase that. There's several different companies there, so it's good to work with a lender. It has lots of different mortgage insurance companies that they can work with. It's something the lender's going to pick out, and that's not something that you necessarily pick out. But the mortgage insurance cost is impacted by many factors on a conventional loan. It's down payment percentage, it's credit score, debt to income ratio, number of people on the loan itself, the property type. Lots of different factors get factored into the ultimate cost of mortgage insurance on a conventional loan. So when you have lower credit scores, sometimes an FHA loan, while it might have that upfront funding fee, might work out to a lower cost for you on a conventional. Now, conventional loans one reason why you might still go with a conventional loan, even though you do have lower credit scores, is because conventional loans will have a higher loan limit, max loan limit, than like an FHA loan. So again, a lot of different loan programs to consider, but those are some differences there. The other thing on a conventional or conforming loan program is that it has a longer waiting period for significant derogatory items. So this would be things like having a bankruptcy, having a foreclosure or a short sale, or having gone very delinquent on payments on your mortgages in the past. These waiting periods that are required are much longer on a conventional loan than they are on a government loan. So that might be one reason why a person who might even have better credit, but because of an event that happened that hasn't timed out yet, might actually go into a different type of program than conventional. Now, Fannie and Freddie, while they are very similar to each other, they have some really important differences, which is also why it's good to work with a lender who can offer both programs for you. And I'll go over just a few key ones here in this video to give you a sense of what this looks like. So student loans is something that's very, very common for our clients. Fannie Mae and Freddie Mac look at these differently when they're in deferred payment, meaning that the person who has the student loan debt is not required to make a payment because they're in deferral. With Fannie Mae, they will require the lender to use 1% of the outstanding balance on that student loan to calculate a payment that will then get factored into the debt to income ratios, which, like we talked about, can have an impact on the cost of that mortgage insurance, but also has an impact on what your max purchase price would be. With Freddie Mac, they actually use a 0.5% of the outstanding student loan balance when they do that calculation. So that means apples to apples, if you're looking at both programs, you'd be able to probably qualify for a little bit higher purchase price with Freddie Mac because they're only using 0.5%, particularly if you have a lot of student loan debt. It also might mean that even though you're planning to buy the same price home, comparing these two programs and actually having a lender that takes the time to do this, you might find out that because Freddie Mac uses 0.5%, again, you qualify for both, but because you're using 0.5%, your debt to income ratio is lower, which might give you a little bit lower cost on the mortgage insurance. So those are important things to look at. So that's, again, a very general overview of a conforming loan, conforming conventional, same thing. If you're a person, you have high credit scores, it's a great program. Don't think you have to have huge down payments or large down payments to go with this program. You can go as little as 3% down. And if you have unique situations, again, this is why you want to work with a lender who knows the different programs, can look at your specific situation to find out, is a conventional loan best for you, a government loan, FHA or USDA? Lots of choices out there. So I hope this video was helpful. If you did find it helpful, please hit the like button, subscribe for alerts to future videos that will be put on the YouTube channel as well. And as always, if you have questions, put those in the comment box or reach out to me directly. And thank you so much and have a great day.